AI has long been about who has the best chips, but as more companies build their own AI chips, a new question is emerging. Designing a chip is one thing, manufacturing it is another. That may be one of AI's most important investment themes. While investors search for AI winners, the bigger opportunity may be the companies that make the industry possible. Hey everyone, I'm Austin. Welcome back to The Everyday Investor. AI remains one of the hottest topics in the market. Some investors are focused on NVIDIA's latest products, while others are watching AMD's market share gains. But while attention is centered on chip designers, I believe one company is being overlooked. Today, I want to explain why TSMC may be far more important to the AI era than many investors realize. TSMC's growing importance in the AI era is closely tied to a major shift taking place across the industry. Over the past few years, most of the discussion around AI has centered on chip design. Who has the most powerful GPU? Who can deliver faster training performance? Who can launch the next generation of leading-edge chips? In that environment, it's no surprise that NVIDIA became one of the biggest winners of the AI boom. But as AI continues to evolve, the industry's focus is starting to shift. As more companies develop their own AI chips, a new question is emerging. Designing advanced chips is one thing. Manufacturing them reliably is another. Today, process technologies below 7 nanometers account for about 77% of TSMC's wafer revenue, while 3 nanometer technology alone contributes roughly 24%. These numbers highlight the industry's growing reliance on advanced manufacturing. Because the more advanced AI chips become, the more they depend on leading-edge process technology. And since only a handful of companies can reliably manufacture those chips at scale, TSMC's importance continues to grow as AI competition becomes increasingly intense. In my view, many investors still see TSMC as a manufacturer, but one of the biggest changes in AI is that manufacturing capacity is becoming more scarce. Because as companies compete to build better chips, production is often limited by manufacturing, not design. And as manufacturing grows more important, another shift is taking place. AI is changing demand across the semiconductor industry. For many years, the semiconductor industry was known for its highly cyclical nature. When smartphone sales slowed down, chip demand usually followed. When PC shipments declined, semiconductor revenue often came under pressure as well. That's why investors traditionally viewed semiconductors as an industry closely tied to consumer electronics. But AI is changing that dynamic. The rapid build-out of AI servers, GPU clusters, and large-scale data centers is creating an entirely new source of demand. Unlike consumer electronics, these projects look much more like infrastructure investments. They require longer deployment cycles, larger capital commitments, and often support demand that can last for years rather than quarters. And that shift is already showing up in TSMC's results. In 2025, the company generated approximately $122.4 billion in revenue, representing growth of about 35.9% year over year. At the same time, high-performance computing, or HPC, accounted for roughly 61% of total revenue. This means the drivers of growth are no longer limited to smartphones and consumer electronics. Instead, AI infrastructure is becoming one of the industry's most important growth engines. And if this trend continues, TSMC's market opportunity could become much larger than it was in the past. This matters for investors. If AI demand is only a short-term boom, the industry could eventually return to its usual cycle. But if AI is part of a long-term infrastructure build-out, the growth outlook for many companies could change. As AI investment continues to rise, the market's focus is shifting as well. The future may be shaped by more than advanced manufacturing alone. Another critical bottleneck is starting to emerge: But even having access to leading-edge process technology doesn't automatically guarantee that AI chips can be delivered at scale, because the AI era has introduced another increasingly important component: advanced packaging. Many investors focus only on NVIDIA's GPU, but an advanced AI chip is more than just a GPU. It also requires high-bandwidth memory, advanced interconnects, and packaging. And CoWoS is a key technology that helps make it all work. As AI models continue to grow, the demand for advanced packaging keeps rising. This means future bottlenecks may come not only from GPU supply, but also from packaging capacity. That's why TSMC continues to expand its CoWoS production. At the same time, the company expects capital expenditures to reach between $52 billion and $56 billion in 2026. For a manufacturing company, that's an enormous level of investment. And those investments reflect something much bigger than just internal expansion plans. They reflect growing industry demand for AI infrastructure and advanced packaging solutions. From that perspective, the future of AI won't simply require more GPUs. It will also require the advanced packaging capacity needed to make those GPUs work together efficiently. What matters most isn't CoWoS itself. It's that AI barriers are getting higher. As more critical parts of the supply chain become concentrated in a few companies, their importance continues to grow. Advanced packaging is one of those areas. And as it becomes more important, more countries are recognizing the value of advanced manufacturing capabilities. Over the past few years, the United States, Japan, and several European countries have all increased their investments in semiconductors. Governments around the world want to build their own advanced manufacturing capabilities. But the challenge is that advanced manufacturing isn't an industry that can be replicated overnight. A lot of people assume the process is simple: buy the latest equipment, build a fab, and start producing advanced chips. In reality, it's far more complicated than that. Because the real challenge isn't building a fab, it's improving yields, refining processes, and controlling costs. And since these capabilities take years to develop and improve with each generation, large gaps can still exist between companies using similar equipment. Today, TSMC generates gross margins of nearly 60% and operating margins close to 50%. For a manufacturing business, those numbers are extraordinary. Most manufacturers face intense pricing pressure that limits profitability over time. Yet TSMC has managed to sustain industry-leading margins for years, and those numbers reflect far more than just scale. They reflect decades of accumulated manufacturing expertise, engineering knowledge, and process optimization. That's why I believe TSMC's biggest moat isn't its equipment. Equipment can be purchased, factories can be built, but decades of manufacturing experience are much harder to replicate. And it's that hard-to-copy advantage that makes TSMC one of the most unique companies in the AI era. Even so, investors remain divided on the company's long-term value. And that division isn't difficult to understand, because when investors evaluate TSMC, they're usually weighing two factors at the same time. The first is the growth opportunity created by AI. The second is geopolitical risk. Therefore, TSMC's valuation may not fully reflect its AI potential. And when we take a longer-term view, another question emerges. Who will ultimately win in AI? It could be NVIDIA, AMD, Google, Amazon, or another tech giant. But regardless of who comes out on top, they all share one thing in common. They need advanced manufacturing. Without advanced manufacturing, even the best chip design remains just a design. At the same time, TSMC continues to generate strong returns on equity and substantial free cash flow. That means the company doesn't just have an AI growth story. It also has the ability to convert that growth into profits and shareholder returns. From that perspective, TSMC occupies a very unusual position within the AI ecosystem. It may not compete directly in AI applications, but it serves as critical infrastructure for many of the companies that do. And that role may be far more valuable than the market currently appreciates. So in my view, TSMC's value goes beyond advanced nodes and AI demand. It's becoming a key part of the AI supply chain. While investors focus on the next AI winner, advanced manufacturing will remain essential as AI infrastructure expands. That's why I believe the market may be underestimating TSMC's long-term value. What do you think? Let me know below. I'm Austin. See you next time.